Here to share what the charts are telling him about this market right now is Renaissance Macro Research Chairman and Head of Technical Research, Jeff deGraaf. Good to see you. So what chart stands out to you more than anything else in the here and now?
Oh, good question. Well, probably of most interest to your listeners would be tech and the relative performance of tech here over the last, call it 2 to 3 months, which is seen a discernible deterioration in relative performance, really only one tick away for us in terms of our criteria from turning to a negative relative strength trend. So I think that one's pretty important. If we want to be really timely, we could say the S&P right here at the 50-day, bouncing right back into this resistance level at what's essentially 54.50 is a pretty key level, and one that we're more interested in selling than buying right here.
What do you do as a chartist? I hope you don't mind that term at all, because I know you do more than just technical research. But I'm sure you could have made the case had you come on, let's say, in the depths of the Monday sell-off, and the charts would have looked horrific, and it would have led you maybe to have a view on, we breached this and we breached that, and this means that we could go down to something. And now we've had this rally back. So how much faith should I put in the charts if in that case it may have told you something that didn't really exist? I don't know if that question makes sense, and if it doesn't, my apologies, but I feel like
I know where you're going with
somewhere.
Yeah, I know where you're going with it. Well, keep in mind, and I think this is important, it's good for context, right? The levels are less important to us than the dynamics. What do I mean by that? We look at oversold conditions. We look at some of these internal measures. And by most measures, we had an oversold condition, regardless of what that price level on the S&P is. As long as you're in an uptrend, which our data tells us that we're in an uptrend, those are usually buyable, right? So we might get it wrong by, a few hours to days and maybe a few, 10s to 20s in terms of points for sure. But getting in the zip code is really what we're trying to do, and that was pretty clear and evident last week. The problem that we have, those oversold conditions in an uptrend buyable, the problem that we have right here is that the momentum taking us higher from those oversold conditions really has not been that impressive. We had 190% day. Yesterday was 84% of the names advancing. It's okay, but there's nothing that really leaps out to us and makes that table pounding and saying, hey, we're right back into this resumption of the uptrend. I would say the things that concern me today, Scott, which are different than where we were, say, two months ago. One is this yen carry trade and the problems with that. Now, I think in the near term, a lot of that was put back on sides, right? We had some excesses there. But we're talking about a trade that's really been in place for 25 years. This isn't some new phenomena. So a lot of the financing that's happened globally, and we're talking about trillions of dollars, has worked its way through the system, through the BOJ. And I don't think that we're done with that yet. I think there's still a problem with that. The other part of this is we're seeing cracks, and we actually saw a top formation in Ether that broke. It looks to us like Bitcoin's cracking. Those are nothing more than, for our purposes anyway, are surrogates of liquidity. And so we're seeing that liquidity at the margin start to deteriorate. So that's what makes us more nervous, and we're sellers of this overbought condition or this resistance level here at the 50-day because we think that there's more backing and filling. We think that there's more testing that's likely to happen, particularly given this point in the calendar. And with that, all still within an uptrend, but with that, it'll require some more assessments as we go. The other thing I would just note, because I think it's important, is the spread between the Fed funds rate and the two-year Treasury is about 125 basis points. That's a huge number. That's as big as it's been since 2008. And usually what it means is the Fed is very much behind the curve. So I think we are seeing these liquidity contractions take place. It's not just in the bond market, but we're seeing other residuals, or what we call symptoms of liquidity. And I think that's really important in where we are right now.